All right, let's get right into it. Today we're breaking down a pretty unique investment fund, one with a very specific and I'd say ambitious strategy. We're going to see exactly what makes the Zerodha Nifty MidSmallcap 400 50/50 Index Fund tick. So let me ask you something. Take a quick look at your own investments. Do you ever feel like you've got a solid, stable base, but maybe it's just missing that little bit of extra spark? That engine for potentially higher growth? If so, you're not alone. That's a super common feeling for a lot of investors. To really get why a fund like this was even created, we need to first look past the usual suspects, the biggest, most famous companies on the market. You see, it's pretty standard for a lot of us to build our portfolios around those large cap stocks. These are the top 100 or so companies, the big, established household names. And that's great for stability, for sure. But the trade-off is that growth can be a bit slower, a bit more moderate. The real high-growth action is often happening just a little further down the list. And that's exactly where this fund steps in. It's designed to fill that growth gap with a strategy that's all about perfect balance. So here's the secret sauce, and it's actually really simple but also pretty powerful. The fund takes your money and splits it right down the middle, a strict 50/50 split. Half of it goes into mid-cap stocks, and the other half goes into small-cap stocks. Simple as that. You get equal exposure to both of these high-potential areas of the market. To make that super practical, imagine you invest 1,000 rupees. The fund's rules automatically put 500 rupees toward those 150 mid-cap companies, and the other 500 rupees go straight to the 250 small-cap companies. There's no manager making a judgment call here. It's all systematic, all based on the index rules. Okay, so you might be wondering, how does it maintain this perfect balance all the time? Well, the key is the index that it's built to follow. Let's take a look at how that actually works. This right here is the engine of the whole thing. This is a passive index fund, which is just a fancy way of saying it doesn't try to beat the market. It just perfectly copies or mirrors the Nifty MidSmallcap 400 50/50 Index. And that index is specifically designed to hold both mid-cap and small-cap stocks and make sure each of those segments accounts for exactly half of the total fund. And we're talking about a lot of companies here, 400 of them in total. That number is really important because it means you get incredibly broad diversification. You're not just placing a bet on a few companies. You're getting exposure to a huge range of industries and sectors all across the mid and small cap world. Okay, we've covered the exciting part, the potential for growth. But now we've got to have a reality check. This is probably the most important part of this whole explainer. We have to talk honestly about the risk involved. And look, there's absolutely no sugarcoating this. You can see it right here on the official riskometer. The needle is pushed all the way into the red. It is officially classified as very high risk. That isn't just a suggestion, it's a formal warning. It means your principal, the money you put in, will be at very high risk. This table really breaks down why the risk is so high. A typical large cap fund is meant to be the core, stable foundation of your portfolio. This fund, on the other hand, is designed to be a satellite holding, something you add on the side for a growth boost. It's investing in 400 smaller companies, and that just inherently comes with much more volatility in exchange for that higher potential return. So, what does very high risk actually mean? Well, it boils down to a few things. First, volatility. The prices of these stocks can swing up and down a lot, especially when the market gets rocky. Second, there's liquidity risk, which means it can sometimes be a bit harder to sell your shares quickly without affecting the price. And third, these types of stocks are cyclical. They tend to do really well when the market is booming, but they can get hit pretty hard during a downturn. So because of all that volatility, trying to time the market with a fund like this is a really bad idea. The sources are crystal clear on this. This is for people with a long-term view. You have to be willing to ride out those ups and downs. We're talking 5 years minimum. All right, so we've laid out the potential upside and the serious risks. Now for the million-dollar question. Does this specific high-risk tool actually fit into your financial picture? Let's see if you fit the bill. This fund is really built for a specific type of person. It's for someone who already has that stable large-cap foundation we talked about. It's for someone who is now looking to sprinkle in some diversification and growth potential. But, and this is critical, you absolutely have to have a high tolerance for risk and be able to stomach the volatility without panicking. And, of course, you're investing for the long haul. If that sounds like you, then it might be worth a closer look. But, one thing that is pretty cool is how accessible it is. You can get started with as little as 100 rupees. This is great because it lets you dip your toe in and get exposure to this part of the market without having to commit a huge chunk of money right away. So, let's wrap this up with the key takeaways. First, its unique selling point is that perfect 50-50 split between mid and small caps. Second, it offers fantastic diversification across 400 companies you probably don't own. Third, and you can't forget this, it is a high-risk, high-reward strategy. And finally, that means patience and a long-term mindset aren't just recommended, they are absolutely essential. And so, at the end of the day, it really all comes down to one final question that only you can answer. Now that you understand how it works, its growth potential, and its very real risks, you have to decide, is this high-octane fund the right kind of fuel to help power your long-term goals?